Right now, first-time buyers and investors are drooling to take advantage of a new loan program on 2 to 4 unit buildings, which drastically reduces down payment by 5 times. So in this video, I'm going to break down some examples of how to use the loan program, some sample prices of the program, and how to take advantage of it an entire month earlier than everyone else before prices jump. So Joel Holland here with One Corner, Keller Williams, One Chicago. Disclaimer, I am a licensed real estate agent and not a licensed mortgage broker. So as we go on, if you have any specific questions on the loan program, we have great trusted lenders to connect you with who are familiar with this program and can help you with all of your financing needs. And if you're excited to see what properties would actually qualify, send me a message, DM me, and I can set you up with a notification for good listings that would actually qualify what we're going to talk about. So first to know of this program will have the advantage. This program may create a lot of new demand and supply is down, and that by nature can drive prices up. So we're going to talk about a bunch of key takeaways for your first movers, first advantage people who can get some takeaways on this loan program. So one term I'm going to use is what's called LTV, or loan to value. This means like how much of a loan you're going to get compared to what it's worth. So for example, as a $500K property, a $500,000 property, we'll use this example a couple times. If it's $500K, a loan of $475,000 would be a 95% LTV, or loan to value ratio. So what this means is this program means a higher loan to value ratio than you would have had before. So previously, investors or owner-occupied buyers of a 2 to 4 unit building had to put down 15, 20, 25% as a down payment. And so for a first-time buyer or even an investor, especially as an investor, that can be a lot, especially in our market, the downtown Chicago area and the north suburbs, where prices are from $400K to $2 million for 2 to 4 unit buildings. So these new guidelines, certain buyers and borrowers can put down as little as 5%, from 5% as opposed to 25% of the loan amount compared to the appraised value. And this reduction can be a game changer for both first-time buyers and even experienced multi-unit buyers and existing investors for existing properties. So this is really important to know. This isn't just for your first-time buyers or for owner-occupied buyers. This is also for existing owner. This is for existing investors. This could be even for buildings that you already own and you're looking to refinance. So all of these mean more financing choices, lower down payments, and easier approvals for 2 to 4 unit properties and buildings. So we're going to go over some quick examples of actual, like, what are prices, what are down payments, and reduced changes before and after of the cash needed to make this program work. So we talked about a $500K example before, but we have a $400K 2 unit or a $500K 3 to 4 unit. So this program goes into effect in mid-November. We'll talk more about that, of dates and timing. But let's say for a 2 unit $400K building, before, the minimum down payment was, let's say if it was 15%, would have been $60,000. That's frankly a lot of people, more than what most people pay in rent in an entire year. And so now, if the minimum down payment would be as low as 5%, that's $20,000. We're talking about going from $20,000 from $60,000. That's a $40,000 price difference, or 10% less than what you would have needed before. That's game changing. And now with that $500K example for a 3 or 4 unit building, previously if you needed 25% down, that's $125,000 for a $500,000 place. Minimum down payment now at 5% is $25K, only 5 times less than what you need. And guess what? There's probably people who are watching right now who are paying well more than $25,000 a year in rent. Imagine buying a $500,000 building for less than you're paying in rent for the next 12 months. So a $400K building, the upfront cash reduction that you would need is $40,000 less. And for a $500K 3 to 4 unit building, $100,000 less. And that's just for a $400 to $500K building. We talked about averages of $400 to $2 million. Imagine, depending on what you're paying in rent, what could that actually do for you for the multi-units that are available compared to what you're paying in rent. All right, We talked about some of the prices that would apply for this program. So what are the main guidelines that you need to know? Well, we already talked about the main benefit. The Fannie Mae's guidelines allow up to now 95% loan to value, as in how much is it worth and how much of a loan you can get. So this means that for that 500K example on a 2 to 4 unit building, you would need 40 to 100K less in about 2 weeks from now than you do today right now. And once again, that's probably what you're gonna pay in rent this year if you're looking at some of these similar pricing. And the key piece, this is for owner-occupied buyers, this is for investment properties, current investors, and even refinancing, which means if you already own it and live in it or already own it as an investor, this applies to you. It's not just first-time buyers or income-restricted buyers. This could be for almost anyone. Now, the really key different piece of this is borrowers can use potential rental income when actually applying for financing. What does that mean? Now, previously, if you needed to qualify for a 2 to 4 unit building or any mortgage, the bank needs to say, hey, you need to be able to qualify for the entire mortgage. You need to show us that you can pay this entire amount back. Well, now you can use what you are likely going to get in rent as income to qualify, which means there's a lot more people who can qualify, who can get approved, because the typical investor loans, you'd have to be able to prove that you can pay for all 2, 3, 4 unit buildings on your own. Now you can say, hey bank, I've never been a landlord before, but I'm going to get 1 or 2 or 3 other units to pay my rent, and that's going to be able to be qualified income for the loan that you're going to be able to get approved for with no track record. So there are some important things to note and some specific requirements and calculations involved on this specific element. So obviously work with a lender who knows what those pieces are, who's familiar with the Fannie Mae guidelines. And one of the main pieces is you must have a current housing expense, as in you have to be paying rent right now. So I'm sorry for those living at your parents' home in their basement. You can still benefit from the other changes, just not this potential rent income to qualify. Key piece, you now have access to a lot more income as the qualification piece. So let's talk about some actual max loan amounts. Previously, there's a lot of restrictions on the dollar amount or loan amount for government-backed or Fannie and Freddie loan products. For a 2-unit building, the max loan amount is $929,850. At the time of this recording, this can change at any moment, but we're talking about over $900K as a max loan amount for a 2-unit building, up to $1,123,900 for a 3-unit building, and just under $1.4 million loan amount for a 4-unit building. And so let's assume the lowest down payment of 5% down payment. For a 2-unit building, a $978,000 purchase price. For a 3-unit building is going to be a $1,183,000 for a 3-unit building, and up to just under $1.5 million, a $1,470,000 for a 4-unit building. This is meaningful, life-changing stuff. This would help you qualify for most multi-units in Lincoln Park, Lakeview, not just income-restricted areas, but this qualifies for a lot of new buyers, a lot of borrowers, a lot of investors in key rent areas. So, who would be interested in this program? We've talked about a lot of this already, of not just owner-occupied borrowers and investors, but let's talk about, we have a ton of clients who would dream of owning a 2 to 4 unit building. And let's own a building one day as a way to start a real estate portfolio, right? But frankly, what if I just want to live in a unit? I'm already living in a 2 or 3, 4 unit building. Maybe you're living in a high rise or a fancy rental building downtown, but let's say if you want to live in a 2 or 3 or 4 unit building, and you just want other tenants to pay all or most of your mortgage. This is where wealth can be built when talking about not just building a real estate portfolio, but for your own owner-occupied property. And imagine if most of your mortgage was paid by other renters in your building. And so a lot of buyers are saying, you know what? I'm just saving up for the right time. Or let's be honest, right now, rates are up, prices are up. So we have a lot of buyers who are waiting for prices to come down, or they're waiting for interest rates to come down. But imagine right now, you are writing a rental check each month. You're paying 30, 40, 50K in rent. If you're paying just 30K in rent, You can own a $600,000 building with 5% down. That's the same $30K down to own a building that's more than $500,000. So that's what this program is about. And especially with these higher interest rates, a lot of people are deciding to keep renting because guess what? That's what they know. But guess what? I also know that rents are up 5, 7, 10, even 30% in some cases over the last 2 years in some areas. And I do know that almost all of our clients that bought 2 to 4 units over the last 1 to 4 years all raised their rents over the last 12 to 24 months. This is a real story. I have a client who bought a 3-unit building in Lakeview. It was a garden unit, then a 2-bed, 1-bath in the middle, and a 3-bed, 2-bath that they lived in on that top floor. They ended up having 2 kids. They moved to the suburbs, and they're now renting out all 3 units. They rehabbed the first garden unit, and that's mostly it. They bought it as the top floor. When they bought it, the top floor was getting $2,600 in rent. When they moved out and they rented that unit, they were getting about $3,200, $3,400 depending on the year. This year, they rented it. They bumped it from $3,600 up to $4,300 in rent. That is paying almost 100% of their entire mortgage for that 3-unit building, let alone the other 2 units that are also providing real income. So what if this could be you raising the rents instead of your rent getting raised by your landlord? That is how you build wealth. Not just looking at like, what am I paying in rent this month or the next 12 months, or what are my interest rates going to be, but what would my mortgage be today? And not just today, but in 3 years, in 5 years, in 10 years, if this is going to be part of a longer term portfolio. And what will rents be compared to my fixed costs? So learning about this program doesn't mean you need to buy right now. It means it's time to get the education to look at your numbers. Listen, prices are up. Rates are up, but rents are up too. So what do we do? What do we do with all this information? This is some of the first impactful and widely available public loan programs that we've since the market totally changed over the last 3 years. And this is actually addressing a real problem of how do we make the barrier to enter homeownership easier for new buyers, emerging buyers, and investors. So for a year, we've been asking for some relief to fight the immense increase and the difficulty of entering the housing market. Whether it's down payments have changed, interest rates, supply, inventory, this is finally a great tool that is actually solving for real buyers and real borrowers certain loan options that now it may require different credit scores and may have stricter criteria, but this is actually solving a real problem for a lot of people. So this is no real estate prediction. I have no crystal ball, but realistically, we're talking about a maintained level of low supply. And now we have a lot more people who are going to be able to qualify for a loan program with needing less down payment. It is likely that this will increase demand for 2 to 4 unit buildings. Can we agree on that? And so what does this mean? Well, we need to prepare for further price increases in 2 to 4 unit buildings, and especially when rent is really high right now. Even with interest rate hikes, if that rent is also boosted, then rent is often more than the mortgages. This is going to be advantageous for a lot of future investors. So we talked about some of the benefits, who could apply, some real numbers. When does this happen? When does this change take place? According to Fannie Mae, this is going to take effect in Fannie Mae's system over the weekend of November 18th of 2023. So here's the trick. Do you want to beat the rush? We just talked about we have low supply. We're likely going to see an increase in demand and prices may go up. Well, interested home buyers, instead of waiting for mid-November, you can actually apply now, today. This is not a sales pitch, but I think we can all agree that you don't want to wait until everybody jumps in the market in mid-November. You can start now, and Fannie Mae specifically says you can apply for a loan now, and as soon as it goes into effect on November 18th, after that weekend, they'll rerun your file on November 20th of 2023. So we already talked about some of the 3 main benefits. Here we're going to get into a more exhaustive list, but number 1, lower down payment. More accessibility, more people can actually make homeownership accessible with this program. Number 2 is this is not only just home ownership, this is income diversification. When owning a multi-unit building, you can actually have additional rental income helping offset your mortgage cost, as opposed to just owning a condo or a single family where you're the only one responsible for that mortgage payment. So income diversification. Number 3 is, we already talked about it earlier, but the rental income consideration. I want to say this a second time because using the rent from the other 2 or 3 units in the building, or 1, 2, or 3 units in the building, can actually help you qualify for the loan. We've never seen that before. This is a huge advantage for certain people to be able to qualify, and more accessibility. Flexibility. This is for a larger range of borrowers than we typically see for loan programs. Often there are income requirements or location requirements or ownership type. This is for one of the widest range of buyers, including first-time buyers, investors, existing owners, and existing investors. Anytime we're talking about home ownership, we're talking about equity building as one of the main key factors, and owning a multi-unit can help often build more equity more quickly than a single family home, because you have other people who are helping pay your mortgage and pay towards your equity improvement. Plus, then, we talked about income diversification. Let's talk about cash flow. The rental income that you can get from other units can actually help with your cash flow, your mortgage payments, your building expenses, and that's a huge benefit of owning a multi-unit property. We talked about this earlier as well, some different qualification criteria. So obviously, you do need to speak with a lender who's familiar with any kind of loan products, let alone this new program, and reviewing your credit score, income, if there's any specific property requirements. So it's important to know that there are benefits there as well. Now, interest rates has been driving a big part of the market, and so we're not exactly 100% sure on how this is going to change rates for this product compared to others. And at the time of this recording, things can change at any moment depending on this current product rate or new rates. So I do say, if you want to talk with a lender, private message me and we'll get you connected with a great loan advisor. We have a main reason to own a home is tax benefits. There are property tax deductions, mortgage interest deductions, and a lot of great advantages for homeowners and investors depending on how you're filing your taxes. And this is a great way to get more people to qualify for those advantages. And in terms of property types, this is going to be for what's called 2 to 4 unit buildings. So where there's 2 different unit mix or 3 or 4 different unit buildings. It has to be under 4 in order to qualify for a residential mortgage of this type, to qualify for the loan program. And now, when talking about income diversification and and talking about rent paying towards your mortgage, you need to make sure that you understand what the rental market is going to be. And so, how much rent are you going to get from those other units, and how is that going to diversify your income and your investment is going to be a key part of understanding this loan product. So what questions should you be asking to figure out who should apply and who is this interested for? I don't have all of the answers, but these are definitely some questions that you should be asking yourself. So who is eligible for this Fannie Mae loan product? We've talked about this is for owner-occupied buyers, investors who are looking to purchase 2 to 4 unit buildings. How does this reduced down payment requirement work? Well, we have some charts and we talked about some sample numbers, but essentially instead of needing 15, 20, 25% down, you only need as little as 5% down. What are some of the income requirements to qualify? That, just like any loan program, is not the purpose of this video. Like any loan, it's highly dependent on your lending profile, your credit, your past performance with rent, and if you've had a mortgage before. So you definitely need to connect with a preferred lender. Send me a direct message and we'll make sure you have a connection with someone who can walk you through the qualifications for this program. Can a first-time buyer benefit from this program? As we mentioned, yes, first-time buyers, owner-occupied buyers, and even existing investors can qualify for this program. Now, what are the benefits of owning a multi-unit property? We talked about a few earlier. So this is one of the main reasons to actually be owning a home, and specifically a 2 to 4 unit building. So we're going to talk a lot more about that in a little bit. And how does rental income from other units affect this loan application? So as we noted previously, this is one of the key main X factors of why this program is pretty amazing. And you can use, if it's a 3-unit building, you can use what the income would have been for unit number 1 and unit number 2. Let's say if it's a 3-unit building and you live in one of them, the income you're going to get from unit 1 and unit number 2 can actually be towards your loan qualification for that mortgage. We've never seen that before, and that's a really huge consideration and change. Now, speaking of considerations, are there any different considerations for investors? A lot of times investors are treated differently than if you're going to own and live in the product or the home or the property differently. And so most programs and down payment programs we've seen in the past, and at least in the last 20 years I've been doing this, most programs are largely treating or benefiting for owner-occupied borrowers and owners. And this is actually treating owners and investors the same, or owner-occupied borrowers and investors the same. That's a pretty rare piece, especially for Fannie and Freddie Mae backed loan programs. Now, we talked about difference of interest rates, especially how interest rates are driving a lot of the market. Interest rates are changing daily for both this product and for traditional loans. So it is my understanding that this will more largely change how people would qualify and the income as opposed to the rate changes. But let's just remember, the less you put down, not only the higher your payments will be, but the higher risk you're going to be to a bank, and there will be often offsets to that. That will be a different video or a different message, but message me for a connection with a lender who can explain those differences. We talked about some of the benefits of, are there any potential tax advantages to a multi-unit or 2 to 4 unit building or this loan program. And so anytime you're going to have an owner-occupied property, whether it's a single-family home, condo, townhome, or specifically these 2 to 4 unit buildings, you'd be able to qualify for mortgage interest and property tax deductions depending on how you file your taxes. If you don't know what that means, that's okay. Message me to find out what that means, or, hey Joel, let's do a video on that. And we'll see if we get enough requests so we can figure out what to do with that from there. But that's one of the main reasons you may want to say, I don't want to pay rent anymore. Let's figure out why my landlord is getting advantages that you're not taking advantage of right now. Because guess what? You are paying somebody's mortgage, and somebody is taking advantage of those property tax, income tax, and interest rate deductions. How about we figure out a way to get you to take advantage of those same deductions? And we talked about this at length. This is just for 2 to 4 unit residential properties, at least at this time. So if you're looking to buy a single family home or condo or townhome, this wouldn't be applying for that particular product. Now, the main piece in a 2 to 4 unit building is, unless you have siblings and friends who are living in the other units, you still need to be paying, those people still need to be paying rent. So how do you assess the market value in the area? And that is one of the biggest meat and potatoes of why you should be working with a professional, not someone who can just do leasing. All real estate agents can do leasing, but this really needs to be someone who has extensive leasing experience. Have they done 10, 20, 30, 40, 100 plus leases? Well, we do have a team of full-time leasing agents. So if you want to learn how to be your first-time landlord and how to do a property assessment on what rents to get, contact us to learn more. So we've talked a lot about the program and who it qualifies for, numbers. What are some things that you can be doing right now? So buyers and investors should both, whether owner-occupied or investors, should take several action items to be able to take advantage of this product. So first you need to figure out if you can qualify for a loan in the first place. So step 1, always contact a mortgage lender. Reach out to a reputable mortgage lender to discuss your specific situation, get pre-approved, get pre-qualified. That's step number 1. You don't go shopping when your wallet's at home, right? So message me for direct contact and intro. 2, making sure that you're understanding your eligibility. What criteria are you going to be able to qualify for in any loan, including credit score, income, and then any property requirements that you would need to know in order to take advantage of the loan program. We've talked about performing a rental market analysis. So I want to spend a little bit of time here. Most of the other pieces and elements and benefits You can probably get by with doing some Googling and get most of your, maybe 90% of the answers that you need and the right good enough Google inputs. This really needs a specialist who can conduct a thorough analysis of the rental market, not just for right now, but what is rent going to be in the next 1, 3, 5 years, and specifically for that product type in that area. This isn't a time where you can just do averages here. You need to be able to predict the next 3 months and look for any properties that have untapped potential. Of course, I'm biased because I'm a licensed real estate agent with 17 plus years of leasing experience, and we always have leasing agents on our team. You need to hire a local pro who has done, in my experience, 100 plus leases in their career, not just an agent who happens to know the area. Plenty of agents will say they can help you with leasing. Very few will actually know what they're doing and help you create a lease structure that will be beneficial for you for long-term wealth building and growth. Now, how do we make sure we make these finances work? You need to develop a budget. Not only just what are my costs, but a comprehensive budget that includes down payment, mortgage costs, ongoing expenses like, am I going to have property management? What's my maintenance going to be? What's vacancy, water bill, trash bill, all of these things, which when you see a lot of residential agents who are listing properties, 2 to 4 unit buildings, a lot of times those fields are blank because they have no idea what they're doing. You need to make sure that those fields make sense for you, for your budget, and to make sure if this makes sense. Well, we need to make sure you're going to gather a lot of documentation to be able to do that. So next step is making sure you have the right financial documents. This is the unfun, unsexy stuff of tax returns, pay stubs, bank statements to really help streamline the mortgage application process. It's like getting audited. There's no way around it. It's going to be painful and frustrating and annoying. And this is where you put in the work to make sure, can this make sense for you instead of writing a rent check each month. We talked about it already. You need to hire a real estate agent, one that's going to be a pro. And we talked about a leasing agent, but if you're considering buying a property, you need to make sure that you're hiring a real estate agent that has experience in not only the purchase market, but multi-units and specifically investments to assist you in not just the search, but the negotiation. And as noted above, one who understands the rental market. So it's very rare to find an agent. Most agents can do it, but very few are good at both understanding and actually executing in the leasing world and in the purchase market and multi-unit place. The wrong agent means that this program isn't going to help you. So you want to know how to hire an agent? Send me a message and we'll schedule a 15-minute call. Worst case scenario, at the end of that call, you figure out what's important for you. Best case, hey, we decide to work together and we can get started taking advantage of this amazing loan program. Now, what happens after that? You've talked to a lender, you've figured out what your budget is, you've figured out if you can actually qualify for a loan, you've hired an agent. Let's start shopping and go looking at places online. So exploring actual property listings. So you're going to start looking for properties that align with your goals and your budget. If you want to find a list of properties that would actually qualify for this, send me a message and we'll go from there. Now, how does this advise? We talked about a lender and an agent as your field of advisors. Well, if you have one, I would highly suggest contacting your financial advisor, wealth advisor. If you're unsure of what the financial implications are in a general investment strategy, this is where you can make sure that these investments will align with your long-term goals. So not only is this loan program going to allow for lower down payments, but there may still be other loan incentives and area incentives that you can qualify for. So make sure you're checking if there are any state or county local incentives, grants, down payment assistance programs that can further support your investment on this homeownership journey. I don't know if there are any requirements at this time, if there are any restrictions on using programs in addition to this, but it's always important you ask. Now, you also need to think about what are other costs and considerations. So we talked about vacancy, property management, but what about things like insurance? You need insurance not only just for homeowners insurance, but landlord insurance, or what requirements are you going to have for your tenants in there as well? Those will impact the costs for your current costs and for your budgeting. And we talked about property management. A lot of people love renting because it's easy, it's convenient. Well, maybe just because you're living in it doesn't mean you have to do all the work. Decide if you want to hire a property manager or manage the property yourself. This may be different if you're living in the property or if you're doing it as an investment. If you want it to be passive or active income, make sure that you have that built into your financial plan. And speaking of financial plan, we talked about speaking with a wealth advisor. Well, you need to make sure, what are my long-term goals in the first place? A lot of first-time buyers that want to own a building or investors say, hey, Joel, find me a good deal. Well, let's be honest. One is, if it's a great deal, I'd probably buy it. But the second is, your goals for your plan and your long-term investment may be totally different than someone else. So make sure that this is in line with your overall goals and financial plan. So, in terms of actual multi-unit properties, if you want to learn more about the market in your area as a general ongoing market report, send me a message, let me know, we can schedule a call, and you can get an actual ongoing market report for 2 to 4 unit properties in your area, your current neighborhood, or neighborhood of your choice. Or if you want to get really specific and really nitty-gritty just for you, we can do an actual 10 to 15 minute call and set up a private customized search that's right just for you, for your criteria, properties that would interest you, for actual properties that would qualify for this program. Let's get started and let's keep going. If you want to learn more about this program, make sure to check out the YouTube link in my bio. I just did a great, long, extensive video on this program to figure out who, how, where, and when could take advantage of this program. Check it out.